Welcome back, everyone, to the Gold Talk Show. This is your channel for, well, really getting into the details of gold news and analysis.
Great to be here. And yeah, the gold market's definitely given us a lot to talk about lately. Prices have been, well, quite active.
Active is one word for it. We've seen some really significant moves, haven't we?
Absolutely. I mean, think about it. Gold prices jumping over 1,000 US dollars. And that's in less than 12 months.
Wow. Yeah, that kind of climb, it definitely gets people talking. Lots of questions.
For sure. And look, if you're holding gold, those gains probably feel pretty good.
Right, who wouldn't be pleased?
Mhm.
But at the same time, when something moved that fast, it can also feel a little, well, uncertain maybe.
Exactly. It can create a bit of unease. And that's really why we wanted to do this deep dive today.
Yeah, we're not here to tell you to buy or sell. That's not the mission.
No, not at all. Our goal is just to unpack what's happening underneath the surface. Look at the forces driving the market right now.
We want to bring some clarity. Maybe you're holding gold. Maybe you're thinking about buying more. Maybe you're just curious why it's moving so much.
We hope this gives you a deeper understanding of the dynamics actually at play here.
So the big question we're tackling at the core of this deep dive is really, is this rapid rise in gold? Is it a healthy, sustainable trend? Or are there maybe some signs pointing towards a potential bubble?
That's $1 million question, isn't it? Or maybe the $3,300 question now.
Yeah, maybe. Okay, so let's start unpacking it. That huge price jump, over $1,000 in less than a year, it really makes you ask who is actually doing all this buying.
And that's really the first critical piece, isn't it? Who's driving this?
Yeah.
Well, interestingly, when you look at the recent data, it seems like the main buying pressure, it's coming from individual investors.
So everyday people, maybe listeners like those tuning in.
Quite possibly, people seeing the price climb, maybe feeling that fear of missing out, that FOMO we sometimes talk about.
That makes sense. Price goes up, it attracts attention, more people want in. But what about the big players? The institutional money, are they doing the same thing?
Well, that's where it gets really interesting. Because, no, the data suggests they aren't necessarily following suit.
Oh, so what are they doing?
If you look at something like the SPDR Gold Trust, which is, the biggest gold ETF, a huge pool of gold that big investors use, it's a pretty good barometer for institutional sentiment.
Okay, yeah, GLD. What's it showing?
They haven't actually been buying aggressively. In fact, if you look closely, their gold holdings have been subtly, well, decreasing.
Decreasing while the price is soaring.
Exactly, a slight, steady reduction.
So you have this divergence, right? Prices shooting up, driven by individuals, while the big institutions are kind of quietly stepping back.
Precisely. And that kind of divergence, well, it does raise a question.
Is that a warning sign, a red flag?
Historically, it's often seen as, let's say, a classic potential indicator of an asset bubble forming. We've seen similar patterns play out before in other markets.
Right, I'm thinking back to things like the 2008 housing crisis, or maybe the tech stock pullback in 2022.
Or even Bitcoin back in 2021, yeah.
Yeah.
All cases where you saw this huge surge in enthusiasm from smaller retail investors.
Just as the larger, maybe more informed players were starting to quietly head for the exits.
That's often how it looked, yes.
Yeah.
Peak retail excitement coinciding with the smart money deciding it was time to take some profits off the table.
So that really brings it back to the listener, doesn't it?
Yeah.
If you're involved in gold or thinking about it, you need to ask yourself why.
Exactly. What's the real motivation here? Is your decision based on, solid research, a clear strategy?
Or is it maybe being influenced by seeing that price chart go up and up and just feeling like you have to get in? That FOMO.
It's a crucial distinction to make because getting swept up in that momentum can be dangerous.
Yeah, which leads nicely into this whole idea of the illusion that prices will just keep going up forever, this psychological momentum trap. You mentioned an anecdote earlier.
Ah, yes. There was this story about an investor, I think in Ho Chi Minh City. This person had been trading gold, short term, making some profits.
Okay.
But then when gold hit $3,300, they suddenly changed tack, decided to hold it long term because they were convinced, absolutely convinced, it was going straight to $4,000.
Okay, so sudden shift based on hitting a new high.
Right. But what they apparently didn't realize, or maybe didn't look into, was that around that same time, some of the larger funds were actually starting to quietly cash out. Take profits.
So they went from active trading based on presumably some analysis to just holding based on pure belief, pure emotion.
It seems that way. And that switch from analysis to emotion, well, that can be a really precarious place to be as an investor.
History shows that, doesn't it?
It does. I mean, think back to the gold market around 2011. You had a huge price run up.
Oh, yeah, I remember that. Everyone was talking about gold as the ultimate safe haven. Unshakable.
Totally. Widespread belief. But what happened next? A pretty significant drop. Gold went from nearly $1,900 down to, what, $1,100?
Wow, yeah, that's a big fall.
And it happened in less than 2 years. Why? Largely because the big money started pulling out.
It's a really stark reminder, isn't it, that
Yeah.
no asset just goes straight up forever. Trees don't grow to the sky.
Exactly. So when you look at today's gold price, pushing these new highs, you have to ask, does this price reflect gold's sort of true underlying value?
Or is it being puffed up by these very high expectations, these beliefs that it has to keep going higher?
That's the critical question you need to be asking yourself. And that brings us to another really important factor that might be flying under the radar a bit.
Okay, what's that?
U.S. Treasury yields.
Ah, Treasury yields. Okay, explain that connection. How do government bond yields affect gold?
Well, think of U.S. Treasuries as like a major alternative investment, especially for big money.
Right, safe government-backed bonds.
Exactly. And since the start of, say, 2025 in this scenario, the yield on the 10-year Treasury note has climbed back up to around 4.5%.
Okay, 4.5%.
Now, if you're a large institution managing billions of dollars, getting a 4.5% return from something as liquid and low risk as a U.S. Treasury bond, that's actually pretty attractive.
Yeah, I could see that. It's stable, predictable income backed by the government. How does gold compare in that situation?
Well, gold doesn't generate any income, does it? There's no yield, no dividend.
Right, its return depends entirely on the price going up. Appreciation.
So if you're managing a huge portfolio, you're constantly weighing risk and reward. Do you stick with potentially volatile gold, hoping the price keeps rising?
Or do you maybe allocate some of that capital to stable, income-producing treasury bonds yielding 4.5%?
Precisely. For institutions prioritizing capital preservation and yield, that choice becomes quite compelling. They aren't as emotionally attached to gold as perhaps some individual investors might be.
So are we actually seeing evidence of this shift? Money moving from gold to bonds because of these yields?
It's probably not a huge, dramatic flood out of gold, nothing that makes headlines every day, but you could argue we're seeing signs of a subtle reallocation.
Like what?
Well, one interesting thing is how gold has been reacting, or maybe not reacting, to signals from the Federal Reserve about keeping interest rates higher for longer.
Ah, okay. Higher rates usually mean higher bond yields, right?
Typically, yes.
Hmm.
And you might expect gold to react negatively to that. But lately, its reaction seems a bit more muted. We've seen some consolidation, maybe some slight pullbacks in the gold price.
Which could suggest that the attractive yields elsewhere are drawing some capital away, or at least putting a cap on gold's rise.
It could be an indicator of that, yes. This competition for capital is real.
And there's history here too, right? This isn't the first time rising yields have impacted gold.
Not at all. If you look back at, say, 2018, 2019, when the Fed was hiking rates, what happened to gold?
It didn't crash, but it didn't exactly soar either, did it?
Exactly. It mostly traded sideways for a period. It wasn't necessarily that investors suddenly hated gold.
It was just that they had this other, safer, yield-generating alternative that looked pretty good at the time.
Precisely. So while gold absolutely has a role in a diversified long-term portfolio.
Sure, as an inflation hedge, a safe haven asset.
Right. But if you're thinking about buying gold at these current high prices, you really need to be aware that these attractive treasury yields, they can act as a kind of psychological ceiling. They offer competition.
You had another story illustrating this point about an investor's changing perspective.
Yes, someone based in Hanoi. Back in early 2023, they'd sold stocks and bought gold. And initially, that worked out well. They saw good profits.
Okay, good timing.
But then, fast forward to the first quarter of 2025, treasury yields are up, bank deposit rates are looking better too.
And suddenly gold doesn't look quite as appealing as the only option.
Exactly. This investor apparently became hesitant to buy more gold even though the price was still high. The relative opportunity just wasn't the same anymore.
It shows how sentiment can shift subtly based on these other available returns.
It does. It highlights that change in the relative value proposition.
So the message for you, the listener, seems to be, take a look at the whole picture. Consider the yield environment. How could your capital be best optimized right now? Don't just chase the price of one asset.
Very well put. And that actually connects to our next point, this quiet retreat we mentioned from gold ETFs. What might that signal about how institutions are thinking?
Right, this idea that the big players, the smart money, often make their moves without a lot of fanfare. So what are we seeing specifically with these gold ETFs, like SPDR?
Well, as we touched on, what's noteworthy is this continuous, it's subtle, but it's a consistent day-by-day reduction in their gold holdings.
Even while gold prices are way up here.
Yes, there haven't been any huge panic selling days reported, just this quiet, steady decrease.
Did
Drip,
you?
drip, drip.
Which really begs the question, doesn't it?
Mm.
If gold is supposedly so hot right now,
Hmm.
why are the biggest accumulators of gold selling, even just a little bit at a time?
That is the crucial question. And to understand it, it helps to remember what they were doing before.
What's the context?
Think back to the period from, say, mid-2022 through late 2024. That was a time of quite a bit of market uncertainty, wasn't it? Doubts about inflation, what the Fed would do.
Yeah, definitely a lot of nervousness around.
And during that period, SPDR and other similar ETFs, they were actually actively buying gold, building up their holdings.
Okay, so they were buying when fear and uncertainty were high. Got it.
So what might their selling now, even if it's subtle, suggest?
Well, maybe. Maybe they feel that the reasons they bought gold back then, the uncertainty, the potential risks, have now been largely, I don't know, priced in.
That's a very plausible interpretation. It could suggest that, from their perspective, the expected gains fueled by those past worries have mostly materialized.
And so the risk versus reward calculation is shifting for them. It's not as attractive to hold as much gold at these higher prices.
That could well be their thinking. We saw something similar play out around the 2011 gold peak, actually.
How so?
ETF selling, again, often subtle at first, started before the major price correction hit, even while many individual investors were still very bullish in buying.
So just to be clear, this ETF selling, it's not necessarily predicting a crash in gold.
Not necessarily predicting no, it's more like a signal of professional portfolio management in action. They're constantly reassessing, rebalancing, managing risk.
Adapting to the changing market landscape, the changing odds.
Exactly. So for you listening, if you're considering buying gold right now, it's wise to be mindful of this. Are you leading the market, or are you potentially following where the smart money has already been?
Are you buying what they might be starting to sell? A really important consideration.
Definitely.
Okay, this has all been incredibly insightful, and it leads us to our final point, which sounds maybe a little ominous, this idea of an avalanche effect, just waiting for a spark.
Yeah, it sounds dramatic, but it describes a specific kind of market vulnerability.
Okay, break it down for us. What is this avalanche effect in the context of gold?
It relates to that idea of expectations versus reality. When an asset price climbs very rapidly, like gold has beyond $3,300,
Yeah.
it suggests that a huge amount of optimism, a lot of future good news, like continued global instability, maybe ongoing inflation fears, has already been baked into that price.
Okay, so the price already reflects a very positive outlook. There's not much room left for more good news to push it higher.
Perhaps limited room, yes. But more importantly, it means there's significant potential downside if anything unexpected and negative happens.
Ah, I see. So the market becomes very sensitive to bad news.
Exactly. This concentration of optimism, this strong belief that prices can only go up, makes the market vulnerable to a sharp, sudden negative reaction, even to something relatively small or unexpected. That's the avalanche.
A small disturbance triggers a disproportionately large sell-off.
Precisely. It happens when confidence is extremely high, when there's this sort of ingrained belief in an inevitable upward trend. It means even a small crack in that confidence, a minor negative signal, can trigger widespread selling, almost like panic.
Because everyone suddenly reevaluates at the same time.
Kind of, yeah. We've seen this dynamic in other recent asset bubbles, haven't we?
Like the ones we mentioned earlier. Bitcoin in 21, US stocks 22.
Even things like the Vietnamese real estate market in 2023. In each case, you had strong price gains, lots of positive expectations, significant retail involvement.
And then a correction, often triggered by something that, in hindsight, maybe didn't seem like that big of a deal.
Sometimes, yes. The trigger itself might seem minor, but it's enough to shift the deeply ingrained sentiment.
So looking at the gold market now, what are some of these potential negative signals or triggers we might be seeing, even if they haven't caused an avalanche yet?
Well, we've already discussed some. You've got some central banks potentially pausing their gold buying streaks.
Right.
You have the ETFs subtly reducing holdings.
We covered that.
And you have the rise in U.S. Treasury yields offering that attractive alternative.
Okay. So these signals are out there,
Yeah.
but gold hasn't collapsed.
Exactly. The fact that gold hasn't really declined significantly in response to these things suggests that the underlying belief, the optimism, is still very strong.
Especially among maybe newer investors who are buying the trend.
That's the potential vulnerability. If a large part of the market consists of newer investors buying based on recent price action and, let's face it, emotion, rather than deep fundamental
Then
analysis,
that market is more susceptible to a rapid sentiment shift, a quick reversal if the narrative changes.
it could be, yes. It makes it more prone to that rapid sell-off if confidence gets shaken.
You used a great analogy before, the suspension bridge one. Can you share that again?
Yeah. Imagine a long suspension bridge. If everyone walking across is absolutely confident it's stable, they just keep moving forward, right?
Steady stream of people.
But what if just one person near the front hesitates? Maybe they feel a slight wobble or think they see something concerned. That single hesitation can ripple backwards. The people behind them pause, look around, suddenly become uncertain, and very quickly, hundreds of people can lose their balance, their confidence evaporates.
Even if the bridge itself is still fundamentally sound, it's
Yeah.
the shift in collective belief.
Exactly. So the key takeaway, the thing you really need to evaluate critically right now is what is actually holding up the current gold price?
Is it solid fundamentals, clear macroeconomic drivers pointing higher?
Or is it primarily built on sentiment, on the expectation that prices will just keep rising, fueled by that recent momentum?
That is definitely some serious food for thought.
Hmm.
Okay, this has been incredibly thorough. To wrap things up, can we quickly summarize the main points, the key takeaways for our listeners from this deep dive?
Sure. I think the main things to keep in mind are one, the rapid price rise seems largely driven by individual investors, maybe fueled by FOMO.
Okay.
Two, at the same time, we're seeing some large institutional funds, like through ETFs, quietly reducing their holdings, a divergence to watch.
Got it. What else?
Three, don't ignore the competition. Rising U.S. Treasury yields offer an attractive, safe alternative for capital, and that impacts gold's relative appeal.
Right, the yield factor.
Four, because so much optimism seems priced in, there's this potential vulnerability to unexpected news, that avalanche effect we discussed. High expectations make for fragile markets.
Makes sense.
And finally, five, it's really crucial to monitor what the institutional players are doing. Their actions, even subtle ones, often provide valuable clues about shifting risk-reward perceptions.
Fantastic summary. And just to reiterate, we've explored all these dynamics, these potential risks and pressures.
Yeah,
But we're not making any definitive predictions here, are we?
absolutely not. Predicting short-term price movements is, well, a fool's errand often. The real goal here is to empower you, the listener.
Right, to encourage informed decisions, decisions based on understanding these underlying market forces, not just reacting to headlines or emotions or following the crowd.
That's the key. A clear-eyed view of the dynamics is essential for navigating any market effectively, especially one like gold right now.
Well, I have to say, this has been a really illuminating discussion, a fantastic deep dive into what's really going on with gold.
Hope it was helpful.
I'm sure it was. And if you out there found this helpful, if you want to keep up with the latest news and get more in-depth analysis on gold,
You know what to do.
please make sure you like this video, share with anyone else interested in gold, and definitely subscribe to the Gold Talk Show channel right here on YouTube.
Your support helps us keep doing these deep dives.
Absolutely.
Yeah.
Thanks so much for tuning in, everyone. We'll see you next time.